Hello, everybody. Welcome to this Minds and Money online global panel session. We're going to be looking today at M&A and asking the question, can we expect an explosion of M&A next year in 2021, given the bottleneck that's been caused by the virus in 2020 so far? And if so, what types of deals can we expect? My name's Graham Dallas. I'm based in London, where I represent the TSX, the Toronto Stock Exchange, and the TSX Venture Exchange, which, as many of you may know, are very important mining platforms. We've got over 1,100 listed companies who've raised over $6 billion so far, the mining companies on our markets this year. We've got more listings and more listed companies than any other stock exchange around the world. In fact, this year so far, we've had 36 new mining companies join our market. We've got a great panel with 4 distinguished guests. I'm going to introduce them briefly and then we'll kick off. We've got Justin Machin, Director of Denham Capital Management, David Street, who's a co-founder and the CEO of Tembo Capital, Dr. Robert Wrixon, the Managing Director of Starboard Global, and Julian Treger, who's Chief Executive of Anglo Pacific. So we've got an excellent panel lined up, and I'm going to ask the panel initially, I think, to give an overview of what has happened so far in 2020 in mining M&A, and whether they feel that there is indeed a bottleneck holding deals up because of the virus. And we'll start in the order that we did the introduction. So Justin, if you could kick off, that would be great.
Great, thanks, Graham. I think there has undoubtedly been a bottleneck caused by COVID-19. We have seen a lot of activity in the gold sector. My understanding is that a lot of the deals that have gotten done are deals where there was an opportunity to conduct site visits before things started to shut down. I think, in the mining sector specifically, when you're investing hundreds of millions or billions of dollars, the principals of the business like to get on the ground and see the assets before they buy them. So I think we have seen a real kind of bottleneck in activity, and I'm expecting as things start to open up, hopefully in 2021, that we'll see some of those deals that have been building in the background start to get launched. I know a number of processes have actually been waylaid and have lost momentum as a result of being unable to complete site visits. So really think that things are going to pick up in 2021.
David, would you like to build on that?
Yeah, look, I think Justin has summed it up pretty well. It's obviously more difficult for people to pull the trigger on large transactions when it's difficult for them to visit site and sort of do that in a hands-on way. I personally actually think that there's been quite a number, and the industry has been quite ingenious, really, in the way that I think, from the latest figures, I think there's $50 billion worth of M&A this year, which is, I think, quite impressive in the circumstances, given not only the COVID situation, but also the volatility in many commodities, throughout the year. And you've seen some quite big deals on the gold side, particularly Endeavour's done a couple of deals, my former employer, and a big one in Australia, obviously, with Northern Star and Saracen. Sort of combination type deals have been done. I actually think, given what's happened this year, that's not a bad sort of tally of transactions. And I think next year, clearly, there is likely to be more as people can get out and about and visit sites.
Robert, what's been your experience of the year, or your view of the year so far?
Well, Starboard plays in a particular space, which is really the small end of town compared to some of the other people on this call. And in fact, I was going to make the point that from our point of view, in fact, it probably hasn't slowed down. In fact, if anything, it's been even faster. But the site visit is the key. Justin mentioned it. David mentioned it. If a site visit is important, and for large transactions it generally is, then it's slowed down. And it's not just M&A; it's all large strategic transactions that involve, getting a company close to production or shovel ready, or a large investment for an expansion, anything like that. You know, there has been ingenuity for sure, certainly at our end in terms of everything has to be done remotely. But where we play, that's usually part of the course. And a site visit for an exploration asset isn't that big a deal as long as you're fairly certain the infrastructure is okay and the relief is okay. You know, you can get the idea from that from a drone visit or from a virtual site tour. You know, it's really about, you know, you're looking about what's under the ground and the previous drill results, etc. So site visit is less important, but for sure there's a bottleneck, and I do have experience some on the board of larger companies who are definitely, things are on hold for a while, awaiting a large strategic transaction, and it just has to wait for a site visit, and that's just the way it is. I think the other thing you're finding is that the deals that have been done are amongst groups that know each other pretty well, and that makes sense. And we're seeing that, I'm seeing that across the board. You know, we're dealing with people that we've already dealt with, people that we know, jurisdictions that we know. So I think, you know, there's definitely a bottleneck though, and there's going to be a lot happening as soon as the world opens up again.
Yeah, thank you. Interesting. And Julian, from the point of view of a listed company.
Well, I think, I mean, we haven't been very active because in a way we do royalties and we do need to do the site visits like many of the other venture capital types. But I think generally in the public markets, scale continues to be more and more important, liquidity. And if we talk about M&A, I think the urge to merge is there stronger than ever, not so much acquisitions. But I do think that we are seeing the signs of a changing M&A landscape, not as traditional as we've seen mining companies buying other mining companies. You know, we recently saw in our portfolio the US government investing in our Brazilian nickel development project, which is the first where they take equity in a project. And similarly, obviously, Tesla entering into mining directly. I think these are all interesting signs that the buyer universe of mining assets is changing and evolving and becoming much broader.
Interesting. I mean, these are two of the things I was going to talk about. I mean, clearly there has been some activity on our market in Toronto. There was Endeavour first with Semifo, and now just a few days ago Teranga. As you said, building scale or the urge to merge. Is the need to get bigger an important driver for M&A deals? Does the team think? And is that specifically because listed mining companies want to and now feel that they can attract generalist investors? Is that a driver for specific transactions? We'll go in the same order. Justin, if you'd start first.
I think absolutely yes, and I love Julian's urge to merge comment, because I think that's the name of the game, and I think that consolidation, particularly in the gold sector, because there's just so many companies, will continue to be a major driver there as companies look to up tier to get inclusion in indexes, and then also to attract generalist flows. We have seen the generalists kind of piling into the gold names now, particularly those that are yield plays, and so I think that yeah, that's definitely the name of the game.
Yeah, interesting. I mean, there are big yields out. I mean, certainly in the majors like Rio and BHP pay 5% yields, don't they, at the moment? I mean, yeah. I think the gold companies it's more like 1%. But anyway, I shouldn't be talking. David, your views on this urge to merge trend?
No, totally agree, and I think it's well known. I think it's all about sort of relevance to wider audiences of investors, scale, liquidity, volume on different exchanges, getting included in indices, all of those good things. Probably more so, frankly, than kind of synergies between assets for the most part. But I think it's all about relevance to more generalist investors. And I think moving, I mean, this is something you probably could comment on more, Graham, but also you've seen companies going on to different exchanges and generally trying to access capital from different places. I mean, the mining sector is quite a small industry in the scheme of the world, and I think there's a natural tendency to try and grow and be more relevant for some of the bigger companies.
Yeah, it's true. I mean, I think if you added all our listed mining companies together, the aggregate market cap's about $500 billion, which is about half an apple. Is one way of looking at it. But you're right. The cross-listing trend seems to have come back to life. We've had Newmont come and list in Toronto from Australia. A couple of our listed issuers, Yamana Gold and Wheaton, have done a sort of listing in London. I guess we'll have to wait and see how that works out. And I sometimes wonder, and this is purely my personal view, whether those cross-border listings aren't partly, clearly, probably, I think that the main reason is to access different pools of capital from investors whose mandates limit them. But perhaps another smaller subsidiary reason might be that it opens up M&A markets to them a little bit more easily if they've got paper that's tradable in different centres. But we'll have to see about that. I've forgotten who's next. Robert, I think, is next up.
Yeah, I think so. Well, my I haven't played there for a while, but my memory from working at the large end of town is that the drive to get bigger is always there. It's sometimes couched in the terms of will be more investable, but it's not always the true reason. But to be honest, there is truth to it, and in fact, I believe that truth is getting even more truthy now, because if you are a generalist fund, let's say multi-platform, multi-sector, you mentioned the urge to merge. They are actually playing the field for yield, and you mentioned yield before. It's very important for these guys, because if you look at the equity markets in general now, if you're an index investor, it's pretty toppy, right? Real estate's a little bit risky depending on where you are. Fixed income is totally moribund. So where do you put your money? I mean, I think there's a drive. I mean, the BHP and Rios, that's fine, but I think they're looking lower to the smaller caps. Well, smaller caps, obviously still quite large, and so if you can get yourself up to the $1 billion market cap range, you become on the radar of some of these big guys. So I think more than ever that driver is real.
It is interesting, isn't it? Because sectors like banks and oil companies that used to be reliable payers of big dividends, well, not anymore. And fixed income is kind of fixed no income, really. Julian, back to you. You gave us this lovely phrase, the urge to merge. Where do you think it becomes important? I mean, I guess if you're a $10 billion company, you're probably investable enough for anyone to, who you want to target to notice. But if you're a $1 billion company, is that too small? Does it need to, where do you think the threshold comes?
Well, I think it is more like $10 billion. I think the pool of traditional mining-focused specialized capital has been shrinking for years. And in order to get a rating, because the urge to merge is driven by the urge to have higher valuations, there's a definite correlation between market cap and scale and rating. I mean, it may also be because people want bigger salaries, but ultimately, the currency is a more valuable currency. And we've definitely seen that in the royalty space. Franco-Nevada, Wheaton are the most highly rated, and they're the largest. And their shareholders are generalists. They're not mining investors. So I think if you're going to get into that sort of index investing, you definitely need to be north of $10 billion. And everybody's rushing to get there. And I think the market in North America is different to the market in the UK. In the UK, people do care about yield, and it's more traditional. But in Toronto and the US, it's less yield driven. So it really is more about your absolute rating.
Yeah, and it's true, isn't it, that all other things being equal, which they never are, but an asset that's more liquid is going to be more valuable, more highly rated than something that's less liquid. So there is that correlation. with scale. Julian, you said something interesting, which I was going to bring up anyway, about Tesla moving upstream, if that's the right word, into lithium mining, having some exposure to that. Do you think with the sort of, if there is going to be a general pivot towards a greener global economy, there'll be other examples of this? I mean, would people who make photovoltaic panels want to own silver production, or are there other examples that you could think of, or the other ones?
Well, I mean, I think generally the mining sector is at a moment of disruption, and it's going to move from a B2B sector, which is commoditized, to a B2C sector, where consumer tastes are super important. And if the miners can move fast enough to provide that green, deliverability, then the suppliers will, or the customers will continue to buy their product. But if they can't, then the customers will have no alternative but to vertically integrate and create their own supply chains. And we're seeing that happen to some degree already with strategic minerals, with China, with Japan, with Europe doing it, obviously the US, the UK, not there yet. But in the past, companies like Ford did enter into platinum and palladium mining, not very successfully. But I think, we always learn the lessons of history. And so I think this could be a trend.
Yeah, interesting. Justin, do you have any views on this as a trend? Do you see any signs of anything happening yet, of new buyers?
I could see it becoming a trend, although I do think it's ill-advised. The mining business is a tough business. And I think if you're not, I mean, there's companies in our sector who've been doing it for a long time who still don't do it very well. So my view is that if you're an EV producer like Tesla, vertically integrating probably isn't the right decision. However, I do think making investments or taking strategic stakes in order to secure offtake is a good move. But I don't think actually becoming directly involved with mining is the right decision.
And David, would you have any views on this?
I would tend to agree with Justin. I think the next sort of leg, and you're already seeing this with some battery manufacturers and others, is almost like what happened in the 1980s with copper. You saw Japanese trading houses, end users, basically buying stakes in assets in copper, securing the offtake. They don't really want to run the mine, but the offtake is the important part. And I think that is interestingly, we sold an investment that we had in a copper cobalt asset a few years ago now. And a couple of the interested parties to buy it were more end user battery type entities at the time. And that was sort of 2 or 3 years ago. So it's definitely something that's happening in the market. I think more likely to be offtake and finance related than actual acquisition of some of these assets, though from the conversations we're having with a few people.
Yeah, and Robert, your turn on this one. I mean, one of the things that we have seen in the past is the big trading houses buying upstream assets, and we can all think of examples both in sort of currently fashionable things like, I don't know, rare earth minerals projects, and unfashionable things like big coal producers. But sorry, Robert, what was your take on that?
Well, no, I mean, I think there's examples. If, as you say, if we do learn from the past, as Julian optimistically suggests, then they should see that if you look at the Japanese trading houses, for example, the way they secured coal, both coking coal and thermal coal, was doing these strategic joint ventures in Australia, and that worked really, really well. The people who've tried full vertical integration, like the steel mills in the past, tried becoming iron ore miners, things like that, or any company that's not actually a mining company trying to own mines. I mean, the oil companies tried to get into it for a while. It's all ended horribly. It went horribly wrong. So there's clearly, if you look carefully, you'll see there's a way to do it right. I'm sure that'll probably what most people do. There'll definitely be some group who will make a full-on acquisition and try to do the mining themselves. It always happens. I could be proven wrong, But it'll happen. But it probably won't go all that well. But there's no doubt that especially in the battery mineral space, where where product specs are so important to the end user, be it the cathode or anode, nickel or graphite or the cobalt that you want, or manganese, whatever you're going for. In that sense, they probably do want to stay in the quality of the ore that's mined and all the way through the value chain, actually, in the processing stages, to make sure that what they're getting is usable. Because it's becoming like, the race to get that last little bit of range on your battery is very important. All the car magazines, rate them on these sort of things now. And it's like a silicon chip. A few impurities can cause the whole thing to break down. So, in that sense, control of the processing, well, from cradle to end use, basically, it will be quite important. So you can see it happening. It'll certainly happen, I imagine.
Interesting, yeah. But there are right ways and wrong ways to go about it, perhaps.
So it seems. Well, as I said, I could be proven wrong. I've been proven wrong many times before.
I mean, if we are going to see more activity and perhaps activity beyond the precious metals or beyond the specifically gold, where do people think that the targets are going to be? Is it brownfield people, projects that are well advanced or maybe in production? Is there an appetite for exploration? In Toronto, we've seen a resurgence this year in small but by their lights well-funded exploration projects coming to the market and raising money, clearly from specialist sector investors. But given over the last phase of the cycle, I think it's fair to say that there's been much less investment by mining companies in exploration. And given what happens with mines, that the life, you approach the end of the life, is it going to be exploration companies that are going to be the targets of M&A, or is it going to be people who are further along in the life cycle? And you go the usual order. So Justin, if I could ask you on that, where will the targets be?
Yeah, so I think as far as kind of continued activity, I think, I know you said don't say precious metals, but I think we'll continue to see M&A activity there. I think consolidation amongst the precious metals royalty and streaming companies will happen as well. And then to a lesser extent, I think there's a consolidation opportunity in the junior copper producer space. As far as M&A activity trickling down to explorers and developers, I don't think we're quite there yet. But I do think that management and investor behavior, like our commodity markets, is cyclical. So I think in a year or 2 years' time, investors will be looking at the production profiles and the reserve lives of a lot of the miners and saying, you guys have been underinvesting in exploration and development for the last 10 years. So I don't necessarily think it's a 2021 thing, but I think 2022, 2023, the mandate will shift from consolidation to attract liquidity, to acquisition for growth, to shore up development pipelines and production and reserve lives.
David, what's your point of view on this?
Yeah,
who are going to be targets?
I think Justin summed it up well, particularly on the gold side. I think the gold market obviously is way more fragmented than the other markets, so it's natural that you'll have more transactions on the gold side than in most base metals. And I think that probably mergers of equal type transactions first, and then that probably filters down to acquisition of projects, given how little money's really been spent on project development in the last 5 to 10 years. I think copper is particularly interesting. I think it's an industry that's got the scale to be interesting for bigger companies. You talk about electric vehicle sort of commodities, and they're all actually quite small industries in the scheme of things. If a bigger company wants to move the dial in terms of its earnings, in the longer run, copper's one of the few industries that they can invest in. It's also very ESG friendly. It's got good fundamentals through electric vehicles, power transition, etc. There's not many development projects around in copper. I think that's particularly an area that's interesting and something that we've focused on over the last few years quite strongly. I think the other thing that's quite interesting, and we've heard quite a bit about in the last couple of years, is the carbon footprint kind of aspects of individual assets. And this is something we've started to think a bit about in terms of ranking our investment decisions and which particular assets have the characteristics of low carbon footprint producers of metal. And I think that's something that particularly the bigger companies will be interested in and focusing on going forward.
Interesting. Robert, it's your turn. You're up.
Yeah, I mean, I totally agree with what the previous two chaps have just said. It's clear. I mean, I would say what you'll see in the exploration and development space is you'll have a little bit of usual consolidation, acquisition that go on, usually based on kind of neurology and very simple synergies. That always happens, and then you know, as if the trickle down does happen, as Justin said, actually a couple of years later, what you'll see is the cherry picking of the very good early stage assets by the majors, which is always the case. I think what you might see if I mean, one thing I've noticed as the pandemic has gone on and on is that there are some winners and losers, as there is throughout the pandemic. And especially in the space, what I'm seeing is that safer jurisdictions are winning, because no one, I mean, for example, from my point of view, I think Kazakhstan's really interesting as a place to get into, and we've got some really good assets we're looking at, but I just can't do a deal there right now without going there and actually meeting people and figuring out how to structure everything. So safer jurisdictions are up, as I said, people that you've worked with before, previous partners. And in fact, I would also say people and companies who have a long experience in this industry, who have a wide connection and network of contacts, are doing better as well, because you can't get out and meet new people. You can't go to conferences if you're a young company or a young person in the industry. So the old hands who already have this network can still call up their mates and get deals done. That's what I'm noticing as well. So you have a barrier to entry into the industry at the moment for new people coming in and new entrants, which I think is quite interesting. And so there's deals that can be done, because there's people naturally by attrition are leaving, but very few people coming in, and it is a cliquey industry. We know this. So it'll become more and more exacerbated if the pandemic continues the way it has and travel is stymied. I don't know if that's going to be the case, but like all things, winners and losers. I got off topic there slightly, but.
Well, I think that's a very interesting point. The value of having an existing network and experience and knowledge, both of people and jurisdictions, and maybe even of specific assets.
Yeah, absolutely.
Gives you an edge when it's much harder to go out and acquire those things.
Yeah,
because of the practical barriers in a time of a virus like this. Yeah. Julian, if you want to add anything to these points, that would be great. But I was going to ask you, we've been talking about all the drivers that will perhaps make M&A deals or asset deals happen. But what I was going to say was that last time round, that kind of ended in tears, didn't it? From an investment point of view, and management got punished quite severely in lots of places for doing M&A transactions. In the more recent phase of the cycle, companies have got themselves into great shape. They're being run much more efficiently. Commodity prices in some cases have really helped, but I think there's been lots of improvement in process and management. And as we've said, they're paying dividends. These companies, lots of mining companies are profitable. They've got good free cash flow, and in some cases they're distributing that to shareholders. Julian, do you think that the market is ready for companies to start spending that money on things other than paying it back to shareholders?
Well, I think the market, wants scale, and the best way for larger companies to get bigger is not to build but to buy, and it's much quicker to do that. The planning cycle, the permission cycle is so long. So I think there will be increasing pressure, particularly from index funds and generalist investors, for scale rather than a return of capital, rather than share buybacks, rather than dividends. But I agree with David that the way in which M&A is going to be received is going to be viewed through a different lens. It could well be, the carbon footprint, the way you're getting involved in the transition. I think also people are going to do much more careful historic audits of the companies they're buying. If Anglo American can be sued for things that they did in the 70s when they don't own the assets anymore, then clearly, legacy issues are becoming very topical, whether it be with the National Trust and Oxford endowments or mining companies. And I think people are going to have to think very differently to that. Just going back to the point about development or large caps, I think there's a huge difference emerging between the North American market and the UK and European markets. Very difficult for small investors to get any information who are retail in this market. And therefore it's easier in the UK, and therefore it's very difficult for them to fund traditionally where they're used to new projects and get those promoters promoting those retail stories. Whereas that continues to be a game that is played successfully in Canada and Australia. So I think you might see more development stuff happening in those markets, not in this market.
Interesting. Yeah. I mean, it certainly seems to be the case that there's much less happening. I mean, well, actually, in all industries, but certainly in the mining industry, on the London market, which used to be a very active junior mining fundraising platform, and now it much less the case.
Regulation has killed that whole market because you can't distribute research in the way that you used to. So people aren't informed. It's easy to go into index stocks. And therefore, I think the cost of that, plus you have, all these automated funds that can't anyway make decisions about funding one project over another. And therefore, you have a very poor junior market here, which is unfortunate for our sector.
Yeah, it's true. Justin, going back to you, are management teams going to be given the freedom to enter the M&A arena, or are they going to be held back by their shareholders, in your view?
I don't think that I think selectively some management teams have the mandate, but I don't think it's really trickled down to everybody yet. Again, I think that 2022, 2023 timeline where investors start pushing for growth and giving the teams that they're backing the mandate to go out and do M&A more broadly.
And David, do you think we're firmly in the period of mergers of equals, which is a phrase we've been hearing more and more lately, before we get to a more aggressive situation?
I think you're starting to see some initial signs that people are looking at a bit more aggressively than they were in the past. There's a couple, but I do think it will take a little bit more time. There's a couple of other things I would say, and one relates to this really goes back to when Randgold and Barrick did its deal. I mean, that was probably one of the first deals where there was no premium. There was a sort of bringing together of the management teams, and traditionally going back to when I was on the banking side years ago, one of the big issues with getting transactions done was always social issues: who was going to be the boss, who's going to keep the job, etc.
Who's going to keep the list?
I cautiously hope that might I cautiously hope that might kind of have moved along. We might have moved along from that. Certainly in restills, the nil premium kind of mergers of equals, and that seems to have been resolved. Maybe my management teams are just getting older, some of them, bad enough, I don't know. That's the first thing I would say. The second thing I would say is that one of the major excesses during the last cycle was the building of capital, very, very high capital cost projects and blowouts on capital by companies. And I think going forward, I think there is likely to be, and I think there should be, a premium on low capital intensity projects in terms of building new capacity in the industry. I think one of the big excesses in the cycle was people building these mega projects with huge infrastructure requirements and so on, and inevitably they ran way over budget. And so I think and hope that might be something we will see. You're seeing quite a number of sort of restart brownfield projects where a lot of infrastructure is already in place and they're relatively low capital intensity to get back into production or to start production.
Yeah.
And actually, I just have a question for David on that. I mean, David, do you see that there will be more kind of joint ventures, particularly in the more capital intensive projects, for risk sharing amongst larger companies?
Well, it's not something we've seen very often in the mining industry, is it really, compared to oil and gas? But you do occasionally see a couple of examples in Latin America. I think it would make a lot of sense, to be honest, for some of the bigger players to do things jointly. But it hasn't happened perhaps as much as it should have done in our industry.
Or maybe those that sort of joint venture approach, or farm in or farm out approach, is actually just a precursor to an eventual M&A finale to the story, or next chapter to the story. There's what's the one's going on? Soul Gold at the moment. Robert, we haven't spoken to you for a minute, and I need you to say something for us, please.
Well, I don't know if it's necessary. I think the chaps have covered it pretty well. I mean, I think the level of aggression we're seeing is a factor of where we are in the commodity cycle, which is in a pretty good place, but it's not booming. It's not bells ringing everywhere. So therefore, there'll be smart M&A, early M&A that makes sense right now. We are seeing, as we already said, this one of the themes of this panel is that the actual cycle might be extended because of the pandemic, because some of these deals can't be done as commodity prices continue to rise. I'm not sure about gold, but it's already quite high. But the rest of the industrial metals and everything else that follows have a chance to actually get quite a bit stronger. And it's when that happens and you get the larger big deals, and then as people see other companies making big acquisitions, then the pressure comes on management. Hey, what are you guys doing? These guys have passed us out. So we might see that in the next few years. It'll happen. It's when you're trying to keep up with the Joneses that pressure comes from shareholders. At the moment, there probably is a little bit of the shareholders reining them in, and they remember the last time and the blowouts, and they don't want to see it again. Not yet, anyway.
I mean, I have to say, I'm not a mining expert. I've worked for stock exchanges for a long time, but I've worked for quite a while now for the Toronto Stock Exchange, and so you pick up things about the mining industry. And I've been there through I guess an up and a down cycle. This seems to me, just almost from a sort of emotional or an observer point of view, like a really good time in the industry. Things are going broadly well, but it has yet, maybe it's just because no one can go to conferences, so there's no opportunity for people to display excess, but there doesn't seem to be excess in the market at the moment. Deals are being done. I mean, this merger of equals concept, I think, is really interesting. That who would have thought that two mining CEOs could see each other as equals? That was like almost against the religion. So it does feel like a period where things are good but not too good, where there's it's that point in the party where everyone's still having a slightly better time as the clock ticks on before you go over that hump. And let's hope the hump is still a long way off. I think we're more or less there, unless anyone would like to specifically say something else. I'm going to try and wind it up with a couple of but I hope will be some sort of summary. But before I do that, would anyone like to say farewell to the Minds and Money audience for this year at least, because I'm sure they'll be back. We will all be back soon in 2021, all vaccinated, raring to go, and ready to hit that M&A world record all over again. And I think it's been a go on, please.
Sorry, I was Graham, thank you very much for hosting this panel today. It was wonderful, and David and Rob and Julian, it was great getting to chat with you guys.
Yeah,
absolutely. Ditto, Justin.
thank you
Well
so
said.
much.